Welcome to this procedural briefing. Our objective is to detail the correct methods for handling complex transactions within the Xero platform. The procedures outlined are derived directly from the training materials of the Academy of Professional Excellence, establishing a benchmark for best practice bookkeeping.
This briefing is structured into 5 distinct sections. We will begin with an introduction to complex transactions, followed by procedures for inventory-based bills and invoices. We will then cover the workflow from sales quote to invoice, followed by methods for handling overpayments and returns. The final section will address bad debts and contra transactions.
According to the source material, all transactions entered into the software are processed into the general ledger. For each transaction, the system automatically creates a journal entry, which serves as the official record. While many of these entries are standard, certain transactions require a more complex procedure. It is these complex cases that are the focus of this briefing.
We will now begin with Section 1, Inventory-Based Bills and Invoices. This section details the procedures for recording transactions involving physical inventory items.
The first scenario presented in the source document is a supplier bill. The company Walk Enroll has received a bill from Wokes Cooking Pty Ltd for 50 units of an inventory item. The total value is $125. It is important to note that this is a credit transaction and no payment has been made at this stage.
The procedure for recording this transaction involves 4 steps. First, navigate to the New Bill function. Second, input all relevant supplier details, dates, and the specific invoice reference number, 4856. Third, add the inventory item, ensuring the quantity and unit price match the source document. The final step is to approve the bill. This action formally records the liability in accounts payable.
We now turn to the corresponding procedure for a sales invoice. In this scenario from the source material, Woke Enroll sells 10 units of the same inventory item to a customer, Cain and Abel Pty Ltd. The total value of this sale is $65.
The process for creating a sales invoice is analogous to that of a bill. You will navigate to New Invoice and enter the customer's details. The inventory item is then selected along with the specified quantity and price. Upon approval, the system records this transaction as an account receivable, which represents a formal record of money owed to the business.
We will now proceed to Section 2, which covers the process of converting a sales quote into an invoice. This procedure is integral for maintaining consistency throughout the sales lifecycle.
The source material defines the sales quote as a formal offer presented to a customer. The provided example is a quote for Floral and Hardy Pty Ltd for a total of $165, detailing the specific goods and their corresponding prices.
The process comprises 5 stages. A new quote is created with the customer's details and the relevant line items. This is sent to the customer for approval. Once accepted, the quote status is updated to accepted. The final critical step is to use the system's function to create an invoice directly from the accepted quote. This direct conversion is a key control, as it ensures data consistency and mitigates the risk of manual entry errors.
Section 3 addresses 2 non-standard but critical financial events: customer overpayments and sales returns. We will now detail the correct procedures for each.
A customer overpayment occurs when a payment is received that exceeds the amount owed. From an accounting standpoint, this excess amount is recognized as a liability, as the business has an obligation to either refund the funds or apply them as a credit to the customer's account. The source material provides a specific case study. An invoice for $165 was subject to a 10% early payment discount. However, the customer paid the full invoice amount. This resulted in an overpayment which requires reconciliation.
The resolution process involves 3 steps. First, the full payment of $165 is recorded against the invoice. The system then automatically identifies the discrepancy and creates an overpayment transaction. Finally, a cash refund is processed from the relevant bank account to return the excess funds to the customer, thereby clearing the liability.
We will now examine the procedure for a sales return. In the scenario provided, the customer Cain and Abel Pty Ltd has returned 3 damaged items related to invoice number 5. An adjustment to their account is therefore required. The correct procedure is to issue a credit note for the value of the returned goods. A credit note functions as a formal record that reduces the amount a customer owes. Once the credit note is created and approved, it must be allocated directly against the customer's original unpaid sales invoice. This ensures the accounts receivable balance is accurately adjusted.
This final section details the procedures for two more complex scenarios: the management of bad debts and the processing of contra transactions.
As defined in the source document, a bad debt is an amount owed to a business that has been determined to be uncollectible. The correct accounting treatment is to write off this amount, which involves removing it from accounts receivable and recognizing it as an expense.
The case study presented involves a debt owed by Sheer Madness Pty Due to the customer's insolvency, Walk and Roll has determined the debt is uncollectible and must be written off.
The procedure for writing off a bad debt also utilizes a credit note. A credit note is created for the full value of the outstanding invoice and is then applied to that same invoice. This action has a dual effect. It clears the balance from the accounts receivable ledger, and it simultaneously records the amount as a bad debt expense in the company's profit and loss statement.
A contra transaction is a process used to settle mutual debts between two entities that act as both supplier and customer to one another. The procedure allows for the offsetting of accounts payable and accounts receivable, with only the net difference being settled by a cash payment. This scenario from the source material illustrates a contra relationship. Walk and Roll has a purchase bill from Treewise Men for $770. Simultaneously, Walk and Roll has a sales invoice issued to Treewise Men for $25. A contra transaction is the most efficient method to settle these mutual accounts.
The technical procedure for this requires the use of a contra clearing account. First, both the purchase bill and sales invoice are recorded as normal. Then, the full amounts of both are allocated against the clearing account. This action offsets the two amounts within that account. The net difference is then reconciled, and finally, the entity with the remaining liability makes a single payment for the net balance, clearing the account to zero.
This concludes the procedural briefing. We end with a key question for consideration. With these procedures understood, how might the consistent application of these principles enhance the accuracy and integrity of an organization's financial reporting? Mastery of these complex transactions is not merely administrative, it is fundamental to ensuring the reliability of financial data, which in turn underpins sound strategic decision-making.